Okay, we are live.
Let me reconnect from computer. Hold.
Yes.
Thank you.
Yeah, okay. Guys, thank you, Daniel. Thank you, Ed. Yeah, let's start. Today, I want to talk about venture capital and private equity. What's going on the investment side? Daniel, maybe you introduce yourself.
Sure.
Yeah.
So my background is in management consulting and banking. More recently, I've been working within the blockchain space. I also have some experience in startups, both this blockchain company that I'm working at called Symbiont, and previously Market Realist, which was another FinTech company. My interest in the space really is just
Okay.
You're losing him?
Yeah.
Perspective. I'm gonna switch connections.
Yeah. You should change. Okay, let's start with that.
Great. So I am, I've got a background in finance and have worked in technology research for quite a long time. I'm doing a number of things right now. One of the interesting projects is the launch of the Great Reset podcast with Julie Albright, who's a digital sociologist, and Brian Hayashi, who's a tech entrepreneur. I also, over the last several years, have been working with Momenta Partners, which is a VC investing in industrial IoT, and I am, been focused very much on disruptive technologies, and a lot of the work that we've been doing around the Great Reset podcast has been a weekly discussion group, weekly salon, where we're exploring the different dimensions of the impact of the current situation and the lockdowns, the economic impact, the shift away from cities to work from home, and also this this continuation of existing trends around automation, remote workforce, obviously the need for high quality connections globally, and we're very much exploring a whole bunch of different aspects that intersect economics, regulatory policy, and obviously human behavior as it's impacted by this by the downturn.
Okay, thank you. And Olga.
Yeah, hi, hello everyone.
Like a short introduction.
You should repeat the question.
No, the first question, maybe it should be like a short introduction about your studio, about your experience.
I'm
in venture capital, yeah.
I'm a co-founder of Venture Studio. We are building in between Europe and the United States. It's 4 co-founders aiming for talented team, first and foremost, as a venture studio, working on healthy living, sustainable life, and working and entertainment. We've been working with entrepreneurs for the last 15 years or up to 30 years, depending on which founder of the studio you take on. I personally been a trader on financial markets and asset manager, and a lot of my perspective onto working with entrepreneurs and with investments goes from actual trading and hedge fund industry, which then converted into working as an entrepreneur, building startups, and now helping to build startups as a studio. And some part to it goes to my experience in working with talents, in events, in between avant-garde jazz and robotics, which gives a big angle towards what a talented team is, how to enhance the team, how to choose the team, and how to actually make it all work at early stage. That's basically it, I think, for now.
Okay, Daniel, maybe, yeah.
Sure. Which part did I
Because,
cut off? Or let me,
like,
yeah.
like
So
the first,
sure.
yeah, the first 2
My
seconds.
background is in management consulting and banking. I also have experience in startups, both at a FinTech startup, market realist that I helped build from 3 people to over 100 people. And more currently, I'm actually working for a company called Symbiont. That is a permission blockchain company. They've been around for about 6 years. I joined them a couple of years ago to help develop the business development area within alternative assets, which include private securities, alternative markets, and supply chain and logistics.
Okay, thank you, Daniel. And first question, let's talk about trends. What's going on in venture capital industry after the after the 2-3 months? What do you think?
If you want, I can tell you the point of view from somebody raising capital as opposed from the VC side, just to have a different perspective.
Yeah. Yes. And yeah. Go ahead.
So Symbiont is about to close a $25 million round, out of which we already have $23 million in commitments. Definitely raising capital during this time, like in the middle of a pandemic, was not ideal. However, in our case, it was to drive an opportunistic acquisition. So that's kind of like why it happened. What we noted from a lot of the VCs, both of course, our existing VCs and also like the new investors we brought on board, on the existing VC side, it was much easier. I mean, they know our story and they're committed, but also in general, and I've also gotten this from other people raising capital, is VCs right now are focusing on the companies that they already own and propping them up with capital as needed. Many of the VCs that were not had not invested in the past, they pretty much said like, we are not taking new companies right now, or we are in an investment freeze across the board, both for existing and non-existing companies. I think one of the issues is that when you have this level of market uncertainty, it's very hard to predict or extrapolate into the future how the market's gonna evolve, and how can you value a company or assess the success of a company if you have no idea what the outcome's gonna be like at a broad economic sense over the next year or two. When you're talking about startups with runways that may be, anywhere between 6 months to like 18 or 24 months on the far end, uncertainty of 1 year into the future is the difference between the company making it or the company going bankrupt. So I think that's why a lot of VCs are being extremely cautious, and it's just due to the uncertainty.
Thank you. And Edward, what do you think? What is the next trends in venture capital and in fundraising?
Yeah, I have to say that, I haven't been that close to early stage fundraising, but I can say that what's surprised a lot of people through the, throughout this downturn is that, even though there's a lot of risk aversion in terms of kind of sort of a broader view of risk aversion in the in terms of doubling down on existing businesses that were premised on prior models and operating without the constraints of the the economic restrictions from the lockdown. The capital markets are open, and there's been just record issuance of debt. I think one of the things that's really notable is that large companies, potential acquirers, have been boosting their balance sheets with with a lot of debt. So there's a lot of cash on balance sheets, right? Corporate balance sheets that represents a pretty a very attractive market for companies that get later stage and are looking to be acquired. Right now, there is certainly in private equity, there's way more capital than there are then there are potential targets. M&A activity has been down this year, partly just because of the concerns of the volatility in the market, but the IPO markets are opening up. I have to say, sort of in terms of, you look at the equity markets, and money is looking for risk, right? With returns of Treasury, T-bills at less than 1%, capital is moving into much more of a higher risk profile. A lot of this is not necessarily going to fund new ventures, and I think investors are taking a closer look at evaluating what types of strategies that existing companies are taking to pivot their operations to adjust to new constraints. But this is, I think what we're seeing here is an enormous amount of capital that's on the sidelines, that's ready to be put to work. A lot of hard work for entrepreneurs to build companies that are going to show growth. And it's all about digital. Like, if you're not digital, if you don't have a digital component to your operations, to your distribution, it's going to be very difficult to prosper. But surprisingly, there are a lot of real, amazing success stories out there. Obviously, biotech is seeing an enormous amount of investment. Obviously the work from home trend has benefited companies that are now focusing on choke points in infrastructure, bandwidth, et cetera. We're dealing with that. The trade restrictions around semiconductor content and the ability to license content from for Chinese companies to license content and IP from the U.S. These restrictions are actually causing a lot of capital expenditures in data centers, in factories, and additional IP. So, this is actually a pretty good environment for businesses that are growing, that are pivoting, that have not been completely shut down and disrupted by the lockdowns. But there's a lot of liquidity out there that's going to make for some attractive exits. And valuations are the other issue. I think that right now we've recovered the market has recovered all of it, everything that it lost in the early part of this year. So now we're kind of dealing with some valuations where there's some real skepticism. And I think that will keep people on the sidelines a bit. But the fundamentals themselves are recovering, and I think in many cases a lot stronger than people thought in the 6 months ago. We're actually in much better shape.
Interesting. Thank you so much, Olga.
I was listening to Ed and Dan, and I was thinking how to angle your question. And I'd rather start with investment perspective, not venture capital, but finance markets. And to be honest, I feel myself lucky to see what is happening with markets right now, because from macroeconomics, asset management, and trading perspective, it's an incredible puzzle, something rare to witness. And everyone who is trading stocks right now, or bonds, or precious metals, whatever, is learning the hell out of it. And it's something which I would love to put my hands on, even to just model a few things here and there from time to time. What is interesting, which is happening in trading, is that even mature companies experiencing a huge jump of user base online. But with that, in recession, which I think already started, I'm pretty sure it will be announced later on, but reality shows that numbers are not good. And third and fourth quarter wouldn't be good. They wouldn't be even bad. I think they will be evil. And we haven't even started seeing manufacturing segments or, well, something much bigger parts of economics. So the thing is, people do not spend money enough, and Twitter base jumped through the roof. It's like 30% jump for a mature company in a quarter is something outstanding, but at the same time, they lost even more money than before. So same happening with startups, surprisingly. they have their unit economics and business models broken at the contradictory places simultaneously, because everyone sees a jump in online versus offline. Everyone understands the shifts, like pains which haven't been addressed before, like online education, remote work, collaboration, the need to have health or telehealth, and well, pretty much every single instrument which wasn't really adopted. If it wasn't adopted before, right now you see a spike. Same time, people do not spend money for what is not extremely necessary. They don't like to actually put money for, well, obviously for luxury, set aside entertainment, because we're obviously all are tired sitting in lockdown, but it's also a very specific segment of entertainment, not all of it. So interesting was that, in my understanding, with money printing, with trying to support economy in the United States specifically, stocks right now started to play sort of higher yields, probably less risks game, sort of safe haven temporarily, so say, I would call it that way. Unlike not just gold or francs as usual. And and it's been traded off, it's been exacerbated by volatile trades, by the algorithmics, by a lot of funds who has to roll over as soon as you hit the next big number because the market goes in. Same time, there have been a lot of traders, who, like starters, young traders, getting into acorns or Robinhoods and changing the movements in the markets as well. And this brings to a completely different angle to investments, because right now, what you see, like I'm looking into early segments. Early segment stage is considered to be a risky profile investment where you have to, well, understand the game, have the pipeline, have the access, but same time, understand the risks involved in this particular investment. And what I've been seeing so far, there are two different games played. One is early stage investors actually change to invest, if they are able to, of course, to move to invest in stocks or real estate or gold or art, to sort of save bets while they are deciding what to do next. Or, and this is the most interesting piece of landscape, angels got into the stage and said, okay, we understand the whole uncertainty. We've been in co-founder's position before. We are willing to take bigger risks right now. And more to that, we've been in IT technologies for years. So this transition to online, even for a huge spike now, which can go down less, is not really surprising. It's exciting. And there are so many opportunities we want to jump in. And those same people, usually those who've been working remote, so they understand how to talk to the team, evaluate the team, and actually make a decision based on a Zoom call. Unlike many more mature venture capital companies, funds, who actually needs to see the full team to make the final decision-making process. So I would agree with Dan and Ed saying that's a lot of money, like people sitting on their hands. I can understand that from trading, even from trading perspective, it's like it's too uncertain to make decisions. It's way too risky than usual, and venture industry is a risky one. And what's the most extreme is not just that you can't actually meet the team and talk to them and understand them better, regardless any due diligence you do. More is that pipelines are broken, business models are broken, unit economics is broken, and either you agree that you will sit hands-on helping a startup if you have resources like that, or you kind of wait and sit it out. And another problem is it seems that there is a genuine cry for a different way of evaluating early growth stage startups. And it's like, you kind of used to take it lightly. And right now, even pre-seed stage with minimal viable team and some assumptions is not enough. It's not about, let's see your sales. It's kind of have to prove it better, have a financial feasibility, have some assumptions on the business model, have some understanding of potential channels capacity in the next round, have a really good understanding what you're lacking, and that you, even if you're a first-time founder, that you have some maturity and you understand what it takes. Because another angle to this is, it's exactly the time to build in hell, and it's exactly the time to invest in hell. But it takes a bit of a different angle to actually evaluate risks in early stage startups. And that I find the most interesting, which is why I see like everybody sitting on different fences, and some parts of investors' landscape getting in and say, yeah, we understand. We are ready for these type of risks. And that's mostly IT crowds, angels, early stage investors who have been working in IT for years and have been sort of prepared to this shift, maybe not that scale, but at least understanding, and who are ready to work hands-on within a startup. And there are a few ventures funds who do that and have been doing that for years, who are also not surprised and help out startups. And everybody else seems to be doing either much bigger rounds or just evaluating way more carefully, because risk profile has changed.
Okay, and next question. What's going on with new technologies? What should be next? Or maybe like business models for the next maybe 15 years? Maybe machine learning. Maybe it should be something for the health technologies, so green. And plus, let's talk about impact investment too. What is the next big thing in technology side?
Well, I could speak to
Yeah,
that.
maybe the VR and ER. Maybe
Yeah.
something, yeah, something for the new business models. Because look at the last 10 years, it was share economy. What is the next? What do you think, Ed?
Well, I actually would say that there's not one new technology or new theme, but what's emerging is this combination of these building blocks that have matured over the past 2 decades. And by that, I mean that, the software as a service / subscription model has been extended to include hardware and services and really physical physical items. I mean, robotics as a service, for instance, is a really interesting theme. This obviously artificial intelligence, machine learning has become embedded into almost every type of software and solutions in every industry. The advancements in battery technology, clean energy capabilities, the declining price of solar, I think is very interesting, but also, the theme of autonomy for not just automobiles, what you call self-driving cars. I don't know that we necessarily get to level 4 autonomy in the next several years, but the technologies are rapidly maturing, and that becomes a very powerful theme. Also, I would say that we have VR and AR are I'm skeptical that those become truly mainstream. They become very relevant for certain use cases, business use cases and entertainment, but I don't know. I think like many technologies that have been pretty hyped, I think the excitement got ahead of the market. I do think, however, that we're starting to see in manufacturing and physical industries a lot of really, really powerful changes that are starting to be applied to smart buildings, construction. The materials science is making up there. We're seeing a lot of improvements there. And a lot of, what has happened with industries that were very slow to adopt newer technologies, particularly manufacturing, construction, are now becoming, far more, focused on automation. I would say, if you look at the oil and gas industry, for instance, which had to go into rapid shutdown earlier this year, the businesses have become very reliant on the extraction business, the exploration production businesses and midstream have become, extremely efficient in the use of technologies. So where I kind of come back to is that, there isn't one sort of killer app or one killer technology. It's this is a convergence of 5G connectivity, the declining cost of sensors, computation, classic Moore's law. You also have Wright's law, which it impacts the declining cost of batteries and remote connectivity. The growth of artificial intelligence, and of course, declining cost of bandwidth. All of those enable vertical applications or industry specific, which I think is really where the big opportunities are, not so much in base level technologies, but in the application of multiple technologies to solve industry specific problems. And I've kind of believed that for several years, but now I think we're really starting to see this play out, particularly in the industrial and supply chain spaces right now.
And blockchain too. What's
Yeah,
going on
blockchain.
with that?
That's right. How can I not? I mean, that was technology, and I mean that had gotten ahead of the curve in terms of the excitement versus the capabilities. But you now are seeing far more mature use cases starting to evolve, and more production applications coming to market. And again, this is part of that mix of foundational technologies that, again, to be able to have trusted micro and very sophisticated automated exchange, whether it be global supply chains or local micropayments. Absolutely, I think blockchain is a major component there.
Yes, thank you, Daniel.
Yeah, I think I guess let's start from blockchain, just of a neat segue.
Yeah, and DeFi too. Yeah.
So in blockchain, what I feel is that there's been a lot of solutions looking for a problem, and in many cases, then what ends up resulting is that you're jamming an architecture into something that is not into a use case that is not ideal. So I think that's also the reason why a lot of companies in blockchain kind of get recycled every few years. Either they do a massive pivot, like digital assets going from running a blockchain to just doing a language, or other blockchains completely disappearing, like the case of Chain that it was bought by Nasdaq in 2015, or they had some partnership with them, and then now nobody has heard of them. At Symbiont, the approach has always been partner with a big dog in the industry and solve one of the problems. So I think that is a more cash efficient approach. When you're in a startup, you're actually working with somebody to address something specific for them, and they're paying for it. So it's a much more sustainable model. And I think in blockchain there was a lot of hey, we have this, you can apply to all these things, but none of those use cases were actually being addressed. And in many cases, there were a lot of POCs to say oh yeah, you can have all these institutions talking to each other. But grabbing 5 different companies and saying hey, I have 5 nodes, this one's yours, this one's yours, this one's yours, and then running something, it doesn't mean those institutions are running the nodes. It just means you slapped a sticker on a node and then said it was from that institution and then made a press release. That is very different than when you actually have, for example, banks running a node on premise, which again, Symbiont is the only company that has done that. We've done that with State Street, Bank of New York Mellon, and Citibank. So those are major words when it comes to adoption. But I'll leave it at that on blockchain, because I can talk about it for hours. On AI and machine learning, I think the technology has matured enough, and to a certain extent, a lot of the basic tools have been commoditized. You can have Python libraries to do very advanced machine learning algorithms. So really what it, and actually I was chatting about this with Manana yesterday, is that really
Yeah.
what matters is what is your, first of all, what is the use case that you're tackling? And do you have proprietary data for that specific use case? Because really it's not the algorithm that you're using to train the model. What matters is the data, the quality of the data, and what is the use case. So that is why, for example, companies like Google and Netflix and Uber and all these ones that have like large AI programs, their value is the data that they have. They have massive training sets that nobody else has. So what the models that they can build are not because of the fancy statistics or machine learning that they do. They're mostly due to the amazing data sets that they have to be able to train models that are not accessible to anybody else. So I think those walled gardens of data are very important. And there's actually like some very early collaborations within the blockchain space as to enable companies to share data without actually giving the data away. So kind of like sharing the data confidentially so you can train models and then people get their data back, but nobody else sees the data. But everybody use common data to train the model. So I think that's something that would be really exciting once it's actually implemented on a large scale. And then another area that I like that it rarely comes into the conversations because it's very far out there. It's definitely what people refer to as deep tech, quantum computing.
Yeah.
Quantum computing keeps gaining traction. I've been to a few conferences, and what I was surprised is that quantum computer has always been 10 years away. From the people that I heard in this conference, they're like, no, we're like 5 years away, 10 at most. So it's like it's a much different horizon for the people that are working in it. There's a lot of money going into the industry. Great example. There's a company out of California called Quantum. They just did $150 million round like in April. So they're not having issues raising money. So there's a lot of money going into it. And yes, it's something that it takes time to mature. And it's definitely a case of something that is, here's the technology, let's find a problem to solve. But this is such a generic and specialized tool at the same time that there won't be a shortage of problems to address once you have actually like specialized quantum computers that can address specific things. So I think this is one where like it's okay that there's no direct use case immediately, and it's more about developing the technology. But those are definitely longer horizon, and that's an appetite, a risk appetite that does not appeal to to most investors. Even for VC funds, we're talking about like these are investments that may not pay off until more than the traditional 5 to 7 year time frame of a given VC fund. So.
Interesting. Thank you so much. It's a great idea about artificial intelligence. Okay, Amalka.
It's actually a good question. I'm not a predictor of technologies, and I've been watching for various emerging technologies for far too long to know that's like, I wouldn't bet on something very specific, but I would probably name a few ideas and a few solutions we've been looking into, which I find scalable and useful in addressing various use cases and various market pains. Well, say personalized shopping, say Spotify for fashion tech, which kind of addresses all those extreme retail shops where you see a huge line of dresses and boots and whatever, and you don't really have a clue sometimes what you need. And it's been crossed over with personalized suggestions. Sort of, yeah, like Spotify. It may be an AI solution. It may be, depending on the startup, it may be a personal guide who helps you to fit, and then you kind of have suggestions based on your particular taste. But at the same time, it's all goes towards consumer-centric experience in a personalized way. It goes into also like the need for effortless shopping and reducing consumer check, because the whole game of getting into, I want some designer thing, I don't want to overpay, it seems to be a general market direction. And whatever solution tackles that and brings you some unique design or unique pattern or fabrics is seems to be quite interesting. But then again, each particular startup had their solution, which may or may not be scalable. So the angle is this one, whatever the solution is out there, it depends on the team and the product they're building. Another example is the e-learning simulators and games aimed for learning verifiably 21st century skills, such as entrepreneurship to start with. The whole edtech is expanding right now, but it's been going there for far too long. I'd say there have been multiple gaps which haven't been addressed before, starting with the whole facilitation and actual course content, and ending with just how online and offline is structured and what we actually need, what you need to learn. Conversation about lifelong learning been around the world for 20 years in my memory at least, but we're only getting here. And solutions which help to collaborate in groups, in smaller and bigger groups, help to idea making and generation, help to decide and support decision-making process and management. They are needed in education and edtech, but as much they are needed in workplace. With that, it seems that in work environments, there is a gap in business process optimization all across the industries in very different ways. Industry 4.0 goes through one part of this, including, say, robotics and IoT, while, say, service economics right now is going through a completely different angle to business process optimization, and some part of it can be digitalized. So there are many new industries which haven't been disrupted before, really, which are getting in there. Laundry service, just to start with. There are many content cutting industries which can be disrupted from an angle of business process optimization and then handling some part of software in it. Then there is quite an interesting thing happening in FinTech, in my understanding, and it goes to consumer-centric, seamless, cross-border payments and investments not in terms of, I'm a trader, I'm a professional trader, I understand what it takes to be a trader. When people get into Robinhood and start trading, likely 90 out of 100 lose their money in the next 3 months. The rest lose their money in the next 12 months. People who actually stay and become traders, it's about 1 in 10,000 people in general who constantly stays and trades successfully. So what we are looking for in our venture studio are not solutions who bring in new people who learn to trade and likely lose money, but solutions more like acorns, which I adore as a whole approach, which helps you invest in a very smart way, which doesn't require you to start understanding the trading immediately, which helps you save in a smart way to get your cash back to some separate accounts. And there are actually multiple ways to deal with it. It's what's most important is there have been a discussion about retail investments in FinTech for years, but who honestly haven't received much attention were just people who don't want to trade and who think they can, but most likely they will lose their money instead of having anything. While there are multiple simple solutions which help to save instead of actually going into trading, which in case of people who haven't done this before is more like gambling. Right now it hits the market pain too, because people are careful in investments, especially people who don't have money to invest to start with. They're looking for savings, and my estimate understanding is that savings will grow while spendings will fall down more and investments will fall down more for just a generic retail individual, someone who cannot afford to really spend more and who cannot afford to invest, or it just doesn't make any sense. And for those people, savings and any models of reinvesting the same and savings, which currency has been playing around, and a few more. Well, there are multiple Asian startups and businesses who angle in this particular point, and it's quite quite interesting to see how they grow. Then cities as services. I mean, urban development, smart cities, new understanding of homes and offices and schools and why we actually need a physical environment. And that goes to IoT and health tech and big data and managing cities in a smart way, and ecology, sustainability, efficiency. Whole Gen Z is all for sustainability, for way more consumer-centric, sustainable, ecological, seamless solutions, which brings one more piece of potential solutions to the picture is sort of meta platforms, integrating multiple different solutions which already been done before under a super simple couple of clicks away interface, helping you get to the service you need without even thinking about who is going to deliver you what, where it's going to be grown, how it's going to be done, as long as you get your, I don't know, super local grown greens delivered to your door in under 15 minutes. And those solutions don't have to be built from a zero ground. You can actually bring together several different providers and put them together. And this been happening in industry, in robotics, for example. It's been happening in FinTech, especially with investments when you need to like partner with a broker. It's seems to be starting to happen in ed tech. And I'm honestly looking forward to see more options. But right now, the most interesting part is we're experiencing 8 Sigma events of disruption across all markets. Hence, we see pain much better. We see changing trends much better, which means that what blue oceans we are watching right now, they seem to be consistent. Like a lot of blue oceans we're watching right now seem to be consistent with long-term development. And there are not many solutions which actually angle those markets. So whatever is there, bring it on. I would love to see everything.
Yes. Yeah, and like the last question, what is the future of impact investment and wealth management in general for the family offices and maybe for the private equity, for the American investors, and maybe your short advice for the startups who want to survive right now? Edward.
Yeah, so I could say that clearly there's a generational shift, right, between the robo advisors and your traditional financial advisors. I'm not sure whether this ends up really carrying over as because one of the advantages of a true financial advisor is the ability to not just to advise on stocks, and robo portfolios and ETFs, of course, have eaten away at commissions for really across the industry. And I do think that many millennials and Gen Z are much more comfortable with using robo managed portfolios. I do think though, as those as the millennials and Gen Z grow up and accrue more wealth and look to diversify, they still are going to need they're going to need advisors and who will be able to direct them into different types of products rather than just trading equities or crypto or whatever it is. If it's liquid, if you're getting into non-liquid assets, such as hedge funds, venture funds, there's always going to be the necessity for human intervention. I do think what's really interesting is that the access to technology is, in some respects, has created a bit of, there's the strength in the market, and I think Olga referred to this earlier, that you have a lot of investors that are coming into the market using Robinhood Interestingly, there's some discussion that the weakness in the U.S. markets the last couple of days was a result of too many people playing options, and it was essentially a gamma trade where there was a shortage of underlying long position, covered long positions, and that was just the market's up again this morning, so I think that's reversed a bit of that. But in many respects, it's a positive sign that the younger generation is trading. I just found out my nephew, who's I think he's 15, made $1,000 trading stocks this summer all by himself at home. My son, who's in college, has been trading credit spreads for the last year. I mean, this is stuff I never even knew about when I was when I was in school. We didn't have there was no online trading, and nobody got into it. So in a sense, it's democratizing the access to information, the ability to play. I think younger investors are going to they'll get burned. That's what happens when you're active. Everybody gets they have to learn their risk tolerance. But I also do think that as the industry evolves, that the traditional financial advisors will have to adapt new products. There'll be less need for your basic asset allocator, and the role of a financial advisor will become much more specialized or somebody who understands specialized products, such as when you do estate planning and insurance and products as well that are not actively traded. That's where ultimately the high value advisors are going to remain. But it's technology's democratizing a lot of this, and we'll see an evolution over the next several decades for sure. But it's not good. Nothing's going away. It's just going to change.
Okay, Daniel.
Yeah, so this is actually a very interesting question, because part of I worked in quant finance for quite a bit, and also the prior startup that I worked at was Market Realist, which was aimed at democratizing investment research by making available free high quality research to retail investors. So this is something that I looked into extensively. I think the robo advisors really, it's not that they are meant to replace financial advisors. I think to Ed's point, it's more to expand the number of people that can use an advisor. Just for example, TurboTax enable a lot of people to do their taxes in a more professional manner without having to go to advisors. This is what robo advisors are doing. In the past, people were still doing their taxes even without an accountant, and maybe it wasn't ideal, and maybe they were overpaying taxes or underpaying. But essentially, these tools allow people to be able to access this. Also, of course, many people actually just manage their long-term portfolio by using the old rule of thumb of a 60-40 portfolio, just a static thing. I think over the past 2 decades, probably the most meaningful innovation that we had, if you can even call it that, was kind of the age-related buckets, where that 60-40 split actually gets modified as you get older, and then you get more and more bonds. I mean, that's just lazy. So the robo advisors actually are a more dynamic way of managing your portfolio, and it's actually helping people that would otherwise not even have an advisor. And also it helps replace advisors that are kind of having their clients' portfolios kind of on autopilot. So I think these may actually also help financial advisors to improve their advising by having more tools that can help them analyze portfolios more efficiently. So I think this is going to help financial advisors, but it's also going to get access to financial advisors that people don't have.
Mm-hmm. Yes. And maybe your advice for the startups.
Well, one of the issues is that they need to ideally have partnerships with large asset managers. Robo advisors, I mean, there's many ways to skin a cat, but it's very hard to differentiate yourself. And the way that you can stand out from the crowd is if, for example, if you're a small startup that has like a robo-advisor product, if you land a partnership with somebody like a BlackRock or State Street, like some large asset manager, and they actually distribute your product through their platform, you're golden. But if not, you're gonna have to be fighting for your market share, and it may be very hard to scale up. And the market is getting very commoditized. So unless you have something for you to like stand out from the crowd, it's gonna be hard. And also, of course, like the first mover advantage is always great. People are still, of course, talking about like TurboTax because it was one of the first ones, and it's still there, even though at this point like, their product is not that different from other ones. But again, like not to expand too much on the TurboTax analogy, but every year people keep using TurboTax because now your history is already there. So once you start using a robo-advisor and use it for 1 or 2 years, it's more convenient to stick to that advisor because all your information about your financials is already there. So there's also a race to get that market share as soon as possible. And if I happen to have a robo-advisor that is small, and then suddenly through BlackRock or JP Morgan Asset Management, I get a free robo-advisor, I'm probably gonna like leave my small robo-advisor that I was like loyal to because now this is offered to me. So I think like those corporate partnerships, even though it goes kind of like against the ethos of, let's not work with big financial institutions. This is actually to like get them out of the market. No, there's got to be collaboration with these financial institutions, and that's how you can really make it in the long term and scale very quickly.
Okay, and our last 3 minutes, Olga. Your advice and what is the future of wealth management and impact investment too?
You were asking the question on impact investing, and I've been thinking about this one. My guess is that it's actually convergent with wealth management because there is, I see a lot of people who are willing to invest with an impact. Problem is that there are not many investments which bring you enough return to actually justify just the label impact investing. And what's most interesting, what I've seen around, is that right now in the current market, I can see business models which will eventually support sustainable living, sustainable life, sustainable entertainment, which are in impact investing with a considerable gain, both for startups or for companies or even for small local businesses. And another thing which I see emerging probably because of my angle to science and engineering is that I'm personally just researching, but I've been talking to a lot of scientists about this, and there is a search for sustainable models which help fund the fundamental research in science, hence impacting the segment of long-term moonshot startups. And models which can help finance that in long term also at some point start to fall down into impact investors scope, which is good. Yeah, I think those are most interesting things right now because we are now able to both invest super short term for 1 year or for a month, and same time find investments for the next 50 years. And I probably will be one of the first people to invest in R&D lab at Hadron Collider in 50 years bond. More to that, I would be happy to structure one and then connect to businesses and small startups and business and small local businesses and startups to help build that, to help bring it out. For startups, I don't know, lots of resilience and luck, I'd say that's the most important. And just keep looking for the best solution. It's like right now, the market requires a lot of empathy. Just be patient, attentive to what you are actually hearing, not trying to convince that your product is fine, but trying to actually understand what people are telling you, what they actually need. And right now, people are extremely open like never before and what exactly they need, and they're not going to pay for anything else. If there was any time to launch amazing solutions and services right now, because everybody is ready to be early adopter, everybody is looking to close their pain as soon as possible. If you are actually addressing the pain, you are going to get your early sales at customer development stage, not later on. So
okay, thank you guys for your time for this panel. See you on the next week. Thank you for your experience.
Thank you so
Bye-bye.
much. Thanks for having us.
Take care. All right. Take it.
Yeah,
Bye-bye.
take care. Bye-bye.